Everybody, welcome to the early July newsletter here. We'll go through a few charts. I hope everybody's enjoying the beginning of summer. We obviously just finished the second quarter of the year, very strong quarter in the markets, bouncing back from what was a very weak first quarter. And we'll show you where that leaves us and where we believe, historically anyway, that the markets could trend from here. Just share a few charts with you. So we're 24, this is the S&P 500, 24% from that bottom in early April, the Liberation Day and the negativity in the markets that followed that led us to that bottom April 8th, 24% rise since then. This, other than this year, is showing the 12-month return after hitting that bottom. You can see there in 2022, we were at this level, but many of those years previous to that, from the bottoms going up 40, 50, 60, even 70%. In the next 12 months. So that does leave some room for some more growth as we move forward. Take another look here. So a bit of a long way to get there, especially with the negativity to start. But we did see in January some positivity there, that green line showing us where we are for the year. The blue line showing the average going back to 1990, and all those gray lines showing us each individual year. So you can see 2008 down there at the bottom, 1995, one of the strongest up at the top there. And so here we are, 6.2% halfway through the year on the S&P 500, puts us pretty much in line with the average year, despite having a very negative period through April and bouncing back. So good sign there that we're back in line. And remember that volatility, and these gray lines are showing you that all the volatility you can have and still end up with that average, especially in the long term. So good perspective there. Show you now what happens when we have this negative quarter that we had the first quarter and a very positive second quarter. So you can see here, obviously this doesn't happen quite as often with that volatility, but you can see what the returns are here. So the third quarter, the returns 100% of the time. That's been higher in these small sample case here, and the rest of the year returns as well 100%, and that average being 10.7% in the third quarter, and the rest of the year 19%. So good signs there, whereas the average is only a 0.7% and a 4.8% for the rest of the year, with those lesser chance of positive returns in each quarter. So good signs there when we get this rebound, that generally that leads to more positivity. And here it is, a lot of info on here, but basically saying when we have a quarter that's over 10%, this is going back to 1950, what happens in the next quarter, the next two quarters, and the next four quarters. And you can see a lot of green on that screen. Of course, you're going to get some negativity in certain years, 2001, 2021. Being two of those cases where you had it in each of the next quarter, 2 quarters, and 4 quarters. But a lot of positivity there. You look out the next quarter, 85% chance that you're positive, a 4.7% return in those 3 months. And looking out the next 4 quarters, of course, we want to look longer term, a 75% chance that you're higher, with a 10.6% average return over the next year when you have a quarter that's over 10%. So that's good, and of course above average from what we've seen on a regular year in all of those cases. So more positive outlook historically when you have that growth that we saw in one quarter. The next quarter, 2 quarters, 4 quarters on average is better than your average year or your average return through a quarter. So all positive there. Of course, there's lots of noise, lots of news. Tariff headlines still making the rounds as we go through summer here. We'll keep you posted with more videos as we move forward, but lots to be positive about, even though we had that growth and kind of got back on track in the second quarter with the returns. So we'll get you another video in a couple weeks. Enjoy the summer, the sunshine with family and friends, and take care, everybody.